right, well, folks, one last time, welcome back to the next installment of the Maximum Performance webinar series. And today's episode is, I believe, episode 173 in the series that we started back in October of 2012. The reason, obviously, we started the series is we wanted to bring together a community of folks who are dedicating to refining their skills and improving their ability to help customers achieve their goals of homeownership and financial growth. And as a result, we've focused a lot on marketing and sales and business development and how to grow a team and a lot of different topics over the years. Feel free to hit the webinar archives on our website if you want to check out some of the previous episodes. But the whole intent of the series was really about bringing to you what you need to be able to do more loans in less time and with less stress. And we've enjoyed a great run of that. Well, today's event is focused specifically on the topic of the new Fannie Mae 10.0 underwriting system that will be coming out a little bit later this month, which comes with it the utilization of a new thing that our industry has never had to work with or deal with before, called trending credit data. So I asked my good friend James Charlet, probably one of the most efficient and effective guys at communicating what's really going on behind the scenes with the whole credit scoring thing. I literally learned more listening to him the first 45 minutes I heard him back in 2011 than I had learned in a 2-day workshop that had been put on by Equifax. And his depth of knowledge about the credit scoring model and how the scoring algorithms work and all that behind the scenes stuff is why I wanted to bring him on to educate us about trending credit data, what it is, what impact it'll have on borrowers, where it likely is to go in the next several years, and how it's going to impact our industry for the foreseeable future, and really little doubt that it's going to be around for a long time. So without further ado, James, I'm going to kind of hand this off to you, let you take it and kind of run with it. We'll, of course, chime out throughout the way. By the way, folks, as you're listening to James, feel free to post questions in that Q&A when you think of them. I know James loves to have the interactive flow of conversation with the audience as we go through today's program. Otherwise, James, tell us all about trending credit data. What is it, how's it work, and where's it going in the future?
Okay, no problem, Eric. Thanks for having me, and hope I'll try not to either talk too fast or be too boring. Those are the biggest threats I have to us here. Yeah, and actually also, Eric, just make sure, you had those 4 questions that you wanted to make sure I got answered. At any point in time that you feel like it's a good time to, for me to get those answered when we're talking, just throw them out there too. But I'll kind of start from the beginning here. Well, I guess I should define first. So what is trended credit data? It is actually fairly simple. It's looking at 2 years of revolving history, and it's only revolving, and I can't stress that enough. People are like, well, what about how I made my car payment? I paid extra on my car payment, or I paid extra on my mortgage. That has absolutely nothing to do with trended credit data whatsoever. Trended credit data is only looking at revolving accounts. Now, it is all revolving accounts, so if you do happen to have a home equity line of credit, that would be revolving, so the way you repaid that would factor in, as well as potentially negatively the balance payment ratio. But what they're looking at is your limits on your balance on your revolving accounts, your balances, and the amount you paid versus the amount that was due. So there's 4 basic numbers, and what they have essentially done. There's a little bit of backstory to this, so bear with me. TransUnion had been the smallest of the 3 credit reporting agencies, still is, but they had been the smallest because they were still owned by the company that founded them, all the way up until 2012. They were purchased by private equity, and the private equity firm that purchased them very, very rapidly decided that they wanted to take them public. Up until that point, the only publicly traded U.S. credit reporting agency had been Equifax. TransUnion was private, and Experian is a British company. They're traded on the London Stock Exchange. So when TransUnion started making that transition to kind of play with the big boys, so to speak, they wanted to make a splash. They wanted to not only be able to go more head-to-head with Equifax and Experian, but maybe even take on FICO, separate themselves from Vantage a little bit. And so they started having some dealings directly with Freddie and Fannie and Ginnie and just the government in general, saying that they believe that they have an idea, so to speak, that something could be better than a FICO score for predicting whether or not someone is going to repay the money that's lent to them. And trended credit data was kind of what they came up with. And so for 2 years, I've heard differing opinions here. The original number I heard was 10,000, but right now Fannie's saying they studied 3.2 million files. So that's a pretty big discrepancy. I'm not sure which is accurate, but nonetheless, for some large number of Americans, they tracked them for 2 years and they looked at this trended credit data. And what they found was it was a better predictor based on their criteria of whether or not someone's going to pay their bills than any credit scoring algorithm that they had ever used. And to me, just this is more anecdotal, I'm going to tell you, but it makes perfect sense. Most people don't prioritize credit cards over their car payments, over their utilities, over their mortgage payments. They're going to pay their water, their electricity, their house, their car, their gas bill before they pay their credit cards. So people that are keeping not either A, keeping low balances on their credit card, which they've always been rewarded for in the credit scoring algorithm, or B, that they have enough money that, yeah, they're using it, but they're just using it for points and paying it down to zero every single month. Those people might not have been rewarded in the past the way that the credit scoring algorithm worked. Because with the credit score, Fair Isaac and Vantage and National Risk Model, Empirica, Beacon, all of those, what they've always looked at is just a snapshot, what's on the credit report right at this moment. So if you maxed out your credit cards last month and they were still maxed out when they reported to the credit reporting agency, it doesn't matter that you paid them down to a zero balance. Your credit score is going to reflect that they're maxed out. Well, with trended credit data, those people that are paying it off every month, it would recognize, well, this person's not a risk. They have lots of money. They're only using what they can afford to use. Likewise, someone who uses just a little bit and then pays it down all the way every month, before perhaps they would have been a no score, because if they paid it down before it got reported to the credit reporting agency and they showed a zero balance, 6 months in a row, then they're not going to have any revolving history to generate a credit score. Well, trended credit data would correct for both of those instances and allow those people to borrow at a low rate, and would be a smoother transaction for the mortgage professional than it is now. However, what it also showed was those people that let's say, well, I think everybody in mortgage probably knows some people in real estate and mortgage that are like this, that, a couple times a year they get a really big check. They get that commission check. They get that bonus check, and they pay down all their credit cards at that point. 9 months out of the year, they're running with all their credit cards maxed out, because once they get that, the money's kind of spent before they get it. Those people would be much more difficult to lend to with the trended data in place, because it's going to show that those are the people most likely to be in default if things go south again. Okay, the first people that went down at the beginning of the Great Recession were the people that were consistently carrying high credit card balances. That's kind of what led TransUnion to start investigating this to begin with. So once they had that data in place, showing that these the revolving balance and payment history was a lot more predictive, perhaps, than what people had anticipated, they went and started selling that. Saying, hey, Freddie, Fannie, Jenny, let's start incorporating this into your underwriting process. And they agreed. And quite frankly, I know that it's been a pain for you guys, especially coming right off of Trek, but Trid, sorry, the reason I drink. I know that it's just another headache for you guys, but I actually do understand why they're doing it, because the predictive nature of that, it just makes sense to me. People that are consistently not managing their credit cards properly they probably are those ones that are going to be the first to default when the rubber hits the road. So obviously Freddie, Fannie, and Ginnie saw that same thing. Now, the original plan, much like TRID, got delayed and delayed and delayed. Nothing that the government does ever happens in a timely fashion when they say it's going to, and this is no exception. This was supposed to be fully rolled out for all loans underwritten through DU, through Fannie, this past June. The original implementation date was June 24th, and obviously it's still not fully rolled out. I believe CoreLogic has set October 1st as when they're going to have it fully implemented. Now, it has been being used. I'm not by any means saying that it's not already out there. CoreLogic was actually testing it in some markets a couple months before June, as early as April. But there's there's a whole lot, and I'm seeing these questions come in, and I'll get to them in just a second. It's not just a matter of, hey, we're going to do this. This isn't data that Equifax or TransUnion have ever collected before. It hasn't been part of their system. And therefore, their subscribers, and when I say subscribers, I mean the creditors, the Citibanks, the Bank of Americas, people issuing the credit cards. It hasn't been part of the data that they've been putting into the universal data form, which is the form that defines every trade line within the credit reporting system. So because that data wasn't there, now it's kind of like putting the cart before the horse. We're telling these credit card companies, hey, go back and find these 2 years of data that you've never had to keep records on before and start reporting that to us so we can create this trended data score. Well, they don't necessarily have that. And if they do have it, it's either incomplete, and obviously the Fair Credit Reporting Act requires that all information within a consumer credit report be 100% accurate, complete, and verifiable. I know it's a high threshold, and if anybody wants, we can get into why it's that high, but suffice it to say, right now, trended data is not 100% accurate and complete. It's just, it hasn't been there. They haven't had it. And that's been my biggest concern with the rollout, and why I've been, even though I do believe that it's a good predictor, I've been happy that it has been a longer rollout, because it's given the subscribers, the creditors, longer to kind of get their act together, because that was my biggest concern, is that as it rolls out, I mean, credit reporting as an industry for consumers has been around since the 1880s. And we still have an error rate per report somewhere in the neighborhood of 85%, give or take. So they've been reporting that information for 140 years, and they can't get it right. And we're expecting them to get all of this data correct for all mortgage loans in 2 months. I think that was unrealistic. This longer time frame hopefully is giving the creditors that need to have this time to at least get their act together. We all know that there's still going to be errors, and the Fair Credit Reporting Act is still going to apply, because it's data coming from a credit reporting agency. It's still going to be something that can, if it's incorrect, if it's incomplete, if it's inaccurate, it's going to be something that can be investigated and corrected. Right now, like I said, we are tentatively looking at a final rollout in October for Fannie. Freddie was originally supposed to be October for LP. That's now been pushed out to first quarter 2017. Ginnie was originally planned for sometime in 2017. I do not anticipate Ginnie using this until 2018. Eric, would you agree with that?
Yeah, I mean, obviously the Fannie is going to be the early adopters. Once they iron out the kinks, Freddie will pick it up, and then Ginnie is always going to be, usually several steps behind on that. Yeah, I mean, the biggest issue I see with the trended data, and James, I think one other big issue or misconception that people need to understand here, and maybe you can talk about this for a moment, is this affecting credit scores now? If so, when will it start affecting credit scores? How does this play into what we're going to have to deal with when it comes to the underwriting flow and process? And what can we do to advocate and help our borrowers with navigating some of the challenges of this? So there's a couple of big topics all thrown in one, but
sure, no, that's fine. Yeah, no, they all certainly intertwine. And as you know, and anybody here that's ever seen me speak or my webinars before, you know that I am a huge gray area advocate. I very much believe that there are no true black and white answers to any question, and particularly the first part of Eric's query there, we don't know. We don't know what we do know is that right now, FICO, Fair Isaac Corporation and Vantage, the two largest providers of consumer credit scores, they have not given any indication of when or if they are going to include trended data into their credit scoring models. Okay, so right now, Fair Isaac is on FICO version 9. Vantage is on Vantage 3. I would say 3.0, but I think it's actually 3.2 now. But they're Model 3 credit score. They have not indicated that Model 4 and 10, respectively, will include trended data. However, I would be extremely surprised if it didn't. Just because if they're the ones that are claiming that they are the purveyors of the most predictive information. They're the ones that are going to give you the best opportunity to not lose money on who you lend to. And they have proved so conclusively through the studies that Fannie and Freddie and TransUnion and Equifax have conducted that this data is predictive. I think it would be very not only disadvantageous but disingenuous for FICO and Vantage to not include it. So even though they haven't said it yet, my gut tells me that when those new models come out, this will be, if not automatically included, at least an option that lenders are going to be able to incorporate into the calculation of the score for themselves. Okay, I mean that's one of the biggest things to understand about all credit scores is they are customizable. You know, your Fair Isaac is not the same as your neighbor's Fair Isaac because you have different risk pools, you have different investors, you have different risk tolerances, and so you incorporate and measure, you know, weight up and down different factors into how your FICO score is going to fit your lending profile. So at the very least, I can tell you, I believe that trended data will be something that you can incorporate into it. Whether or not your lender does that is probably going to be up to you. Again, because it is so predictive, I just can't see any lender not saying this at least has to be a component of our lending decision above and beyond what's already happening through the Freddie, Fannie, and Ginnie systems. Because if you're doing something that's outside of them, you know, something completely non-conforming, not that anybody's doing a whole lot of that, but if you are, you still want to have the most predictive data in your decision-making process. So I can't imagine a scenario where it's not there. So I'm going to digress for just a second, look at a couple of these questions. Oh, actually, real quick, one other part of Eric's question on what can we advise consumers? You know, for years and years and years, I've been saying, find out what date your credit card is reported to the credit reporting agencies. And more often than not, 99.9% of the time, the same day as your statement date, the date that from your credit card company, your statement is generated and put in the mail and sent to you, is the same date they generate the sequential data tape and send that to the credit reporting agencies. It's the same day. So I've said for years, make sure that you're below 10% when that happens. Now that's still good advice when it comes to the credit scores, but for trended data, the best advice we can give them is don't live above your means. I mean, I know that sounds crazy, and it's like, well, of course everybody knows that, but do they? Do they really? This is going to be measuring whether or not you can afford the revolving credit that you're borrowing. That is what it's designed to measure, and that is what has been determined to be such a predictive factor. You know, you have this much of limit, you've borrowed this much against it, here's your minimum amount that's due, and here's the amount you paid. If this, you know, here's the minimum amount due. If it's this way towards what your owe or what your limit is, that's good. If it's this way back really close or right at the minimum and your balance is really close to this limit up here and you're doing that on multiple cards, and that's worrisome. For mortgage providers, for mortgage lenders, it's going to be, well, for the insurers, for Fannie and Freddie, that's something saying, well, I don't necessarily think that indicates that they are managing their finances in a way conducive to homeownership. So that the best advice we can give them when it comes to that is truly just don't put more on your credit cards than what you're going to be able to pay a significant portion of within your budget each month, because that's what this is trying to measure. So let me go to these questions real quick here and get these answered. I'm going to get some more as we go through. So clients also play the game with zero interest credit card promotion. Yeah, I know that. I don't. So really what's going to happen with that, you're still going to have a whole lot. Let's say somebody has 5 cards with $5,000 limits against $6,000 or $4,000 balances against $5,000 limits. And they get an offer for a single $20,000 card with a 0% balance. They transfer over. Now they've got 16 against 20, but that's not actually accurate. Now they actually have 16 against 40 because those other 4 cards are still open with a 0 balance. And so it's going to show that they have this limit that they're not, that's still going to go into trended data. It's going to show that they made a $5,000 payment within the last 2 years and a $5,000 payment. So it's going to show they paid off all these credit cards in the last 4 years. And then if they're making additional payment above and beyond the minimum on this 16 out of 20, then I think that that's still going to that is not going to be a detriment to them. Even though they have that one higher balance limit, as long as they're making good size payments, which you would think they would be doing with a 0% interest, they want to get it paid off, because if they don't pay it off within that promotional period, then all of that interest is going to accelerate and they're going to be charged that. So hopefully, again, if they're managing it properly in the way that it's designed to be managed, they're making a payment above and beyond that minimum, and that's actually going to reflect positively for them in the calculation of the trended data. Okay?
Right.
So we'll balance.
So let me ask you a question there, James. I mean, one of the things that we've done, there's two types of education that we talk about frequently, and especially in like some of the Becoming a Credit Educator course materials that you and I have put together over the years, stuff like that. I mean, one of the things that we talk about, there's a difference between credit education and how to better and more responsibly manage credit that is a little different, or has traditionally up to this point been a little different than financial management, household budget type stuff. And so we always have talked about sometimes the conflict in the past that have come from, what you do to build a good credit score may not necessarily be the smartest thing to do from a fiscal responsibility and how to build wealth as a family perspective. Now it sounds like there's kind of an alignment between, budgeting, proper spending habits. But at the end of the day, when we think about balance rollovers, particularly to this question, would it still benefit them to keep those older cards open and continue to, because one of the things we always talked about, how do you rebuild from bankruptcy type thing? You open a couple of cards, you put a tank of gas on them once a month, you lock them in the sock drawer, and you leave them alone, right?
But I put them on ice. That's put them in a bowl of water and stick them in the freezer. That way you can only get them with a hairdryer. And all of those types of things. And you're absolutely right. In credit, there have been so many instances where the goose and the gander do not align the way that they that you would expect them to. This is going to be an exception to that. This is one where keeping good financial practices is going to align perfectly with the way that you're being evaluated from credit. I mean, if you're managing your credit cards in a responsible manner, you're going to be rewarded in this. That's one of those reasons that as much as I know it's a pain, I have not been, obviously Eric's heard me speak enough time. I have no problem speaking my mind when I don't agree with something or I think that something's unfair to the consumer. This is one of those instances where I actually think that they have done something good here. This is something that it makes sense. It's not just, sometimes with credit, common sense and what they do don't necessarily align, but it's common sense, it's lending sense, it is predictive, it's risk. They all kind of come together here. This is not a bad thing for consumers that are paying on time. And for those that are kind of riding the lightning, this is going to kind of pull those people out a little bit more and put a little bit more of a spotlight, and they're going to have to explain why they're doing that. I mean, it's not going to be an automatic decline. They're not, it's not going to just say, oh, don't lend to this person necessarily. It's going to say, answer some more questions. Find out why are they carrying such high balances on their credit card. Maybe they just started a new business and they have so much potential income coming up. Like we talked about with doctors and lawyers when they were in school, and we would give those no interest or interest-only loans because they're in neurosurgery school. We know they're going to be making $800,000 in 2 years. It's okay to give them that little bit. We probably shouldn't have given that to Bob the mechanic, but giving it to the neurosurgeon, that's okay. Same type of thing here. It's just going to require a few more questions to ask to say, okay, well, either it makes sense and we can justify this, or we can't. They're just living beyond their means, and we don't need to increase that burden. So that's right. That's what I see for it. And like I said, this is one of those where I believe that the actual risk and the real life risk, or I should say the mortgage risk and the real life risk, really they have the same, they have mutual interest, I guess you should say.
So let me just before we answer that one particular question, this kind of goes back to the old, chicken and egg. Like one of the things you taught me a couple of years ago was something that was always kind of a misnomer to me. I had always thought that establishing more installment debt was better for building a credit score, because when you think about fiscal responsibility, installment debt, you make a purchase once, you pay it off over 12 months, you've had to think about your budget up front before making that payment commitment, is a more responsible use of credit in most people's common sense logic, but that never really worked right when it came to building a better credit score. Credit score, you used to have to basically, and like one of the most unfair things about the more traditional scoring models was the whole limited credit user situation. The family who follows like Financial Peace University methodology, no, all debt is bad debt, have no debt, right? Problem is you had no credit score, and it was kind of hard to get a loan when you really needed one, if you needed a vehicle to get to work, or if you wanted to buy a house, kind of thing.
Beyond that, nowadays, without a credit score, it's difficult to get a job. It's difficult to get insurance. It's difficult to get utilities without a big deposit. It's now that it's really got, since credit scores have their tentacles out into so many different fields above and beyond just borrowing money and having debt. It's made it a situation where you have to have debt. Dave Ramsey, God bless him, but it just doesn't work the way that he says in the real world, because the credits, you'd be amazed how many clients for our credit services over the years, for those that don't know this about us already, have not been able to get security clearance. Myself, I was in the Navy. I had to have a security clearance for explosives ordnance disposal, and they did a very thorough credit check and with credit scores on me. And this is back in the late 90s. Nowadays, it's even more intense. They're looking at your financials. They're looking at, not just that, but at tenant tracker and at check systems. So not even just the traditional consumer credit reporting, but also how have you managed your apartments? How have you managed your bank accounts? For a lot of jobs, particularly if you're trying to get in the financial sector, they're going to look at more even than just your consumer credit reports. So it's one of those things where you can't just think of it as only impacting whether or not you can get a house or a car. But the one I always say, Eric, is this is a true quote from Farmers Insurance here in Plano, Texas. $150,000 house. For those in California, no, it was not an outhouse. It was an actual regular-sized house. But same exact quote, same coverage, same house, same everything. 580 credit score versus 720 credit score. The 720 was an $895 annual policy. The 580 credit score was a $3,750 annual policy. Okay. And so, and we got to think, if trended data goes into FICO and Vantage and insurance risk and bankruptcy risk, and they start incorporating all that, then it's something that you're going to have to consider, whether or not you're managing your credit cards right, to see whether or not you're going to pay an extra $3,000 a year on your homeowner's insurance.
Right.
And, which is crazy.
Right. So in specific reference to this one question from David here, it says, why does trended credit data show, I guess the term trended credit data showed up on his credit report under an installment loan on his credit bureau when it's not used for installment loans?
Yeah, because
more of a miscoding thing.
No, I don't think that's it at all. I think, that's a possibility, Eric, for sure. But my guess would be that I would want to know what bank it is. Maybe I'm wrong, but I'd be surprised if it's Citibank or Bank of America or Wells. If it's, I would think that if it's a bank that's issuing credit cards and installment loans, that they probably just, when they first got notified of it, they just threw the last 2 years of payment history out there for all their trade lines onto the report just to make sure they were in compliance. Because you can never report too much data, but you can certainly not report enough data. So just because it's on the report doesn't mean it's factored into that trended data score, and I'm using the term score, but that's really not the right way. It's just the easiest way to kind of say it. But that trended data calculation, just because that installment information is there doesn't mean it's being factored in. It just means that that bank was probably being overly cautious in reporting that for more trade lines than just their revolving.
Okay. All right, so we talked about the concept that this isn't affecting credit scores yet. This is just affecting how the automated underwriting system is going to review that customer's credit profile. So that data is being pulled in along with the credit report, dumped into the automated underwriting system, and then the system is making a decision about what it's going to do with that. Do you have any indication, or have you seen any data as to how that's going to be presented to the consumer? How would we as a loan officer know what was or wasn't being done through the DU underwriting process in relation to that data? Have you seen anything behind the scenes related to that?
I have. I got, basically through some of my government contacts, I got some more in-depth information on kind of why they had made their decision, and just, I don't know. You know, government writers don't always know what they're, when I read Fannie's memos, their internal memos, I always just kind of do a little bit of smacking my head. But I believe when the full rollout is completely done, that the user manual, so to speak, the internal, is actually going to be able to tell you a lot more than it even is right now. So I know probably some of you have already seen trended data, not only on the report, but have probably even seen kind of a proto 10 and seen a trended data section within within your underwriting system. Once that full implementation is done across the board, there's going to be more, basically more help file, more of the little info circles that you see in there that you'll be able to click and figure out more about what all those mean. But they are integrating more help functionality in the final rollout.
Okay. So, guys, and by the way, keep posting questions for us, because I'm feeding off a lot of what you guys are sharing with us through the chat here. So keep asking those great questions. One question that came up here, James, and it kind of references the particular slide that I'm showing on the screen, as well as the previous slide that talked about the different patterns and what's going on. Can you talk a little bit about how trended credit data is going to help consumers? I mean, who are the borrowers that are going to most likely benefit from this?
Yeah, absolutely. Well, number one, and I'll use a personal anecdote to explain this. I had this. This is one of the things that really just one of the final straws for me leaving Experian. For those who don't know, I used to be a legal executive in CAS at Experian, and a case I had to work on and do some affidavits for was basically the gentleman owned a sole proprietorship, very successful painting company. And he had an American Express open account, and this is the mid-'90s, where he could write checks off of it. I mean, he did everything off of his American. He did his payroll, he bought his old supplies, and essentially at the beginning, and just he kind of did a first in, last out kind of system, which is not exactly LIFO or FIFO, but nonetheless, he would buy everything at the beginning of the month and then collect, and then sometime in the late 20s of each month, he would pay off his entire American Express bill. Unfortunately, they reported on the 20th. And just the way that his cycles and his invoices were, there was just, he'd try and there was nothing he could do about it. So this American Express card, and again, he's a sole prop, so it's showing up on his personal credit report, and he was putting about $60,000 to $70,000 at the beginning of each month. And it was one of those, like with his open account, it acted more like an American Express Blue or Clear, so that it reported a limit. And so basically, it looked like he was maxed out for, you know, $70,000 out of $75,000 every single month, and he sued us over it, and we ended up prevailing. But it's because we were inflexible. We wouldn't move. American Express wouldn't move the date. We wouldn't change anything, and he was just stuck with his credit score in the. It was actually usually in the 660s, 670s, even though really he should be above 750s, and it was because of the credit load and the balance limit ratio, and just that combination was really just hurting him severely, making him appear to be fair credit when really he should be perfect credit, and costing him, you know, not an insignificant amount of money. So that type of borrower, you'd have no problems with in this system. Trended data would show immediately that he's paying it off every single month, and he would sail through. It would be, you know, with the best possible rates and everything. So it would correct for that. So those people that are managing and paying off, but the credit score is not reflecting it, that is the most obvious example of who is going to be very helped by this. Also, those borrowers on the cusp that are building their way up, and you can see it, where they're paying significantly more, you know, double or triple their minimum payment each. Maybe they got in a hole, but now you can see in the last 6 months they've been paying extra money every single month and digging themselves out, and they can afford that. Those people you're going to have an easier time lending to as well now. So, Eric, maybe you got something to add. I'm going to read these questions real quick here because we just got two long ones. Let me start
definitely. Yeah, if you want to, read through those really quickly. So, guys,
Sure.
one of the things we're talking about here is from a business development sales perspective. There's two key things that I'm hearing James say. One is it's about fiscal responsibility, and hopefully in the near future, eventually. And James, one of the questions I'll have you address at some point is when will this actually start affecting FICO scores, and all the other different scores that we work off of when it comes to the underwriting models and the guidelines. But even in the interim here, when it comes to conventional, especially Fannie Mae's availability to do loans for customers who may have already been at some sort of disadvantage. Like, for example, one of the things that James and I used to educate when we would teach which, by the way, I'll introduce you guys to a little bit more about what the Becoming a Credit Educator web shop series is by the end of the program here. But one of the things we used to teach in the original course, and we're actually redoing the course because there's so much changing right now, but one of the things we always used to advise folks to do is teach their customers to manage the payment date and pay the statement, pay their credit cards, pay their revolving accounts a day or two before the statement date of that cycle, because 99 out of 100 times they report the balance. And the way it used to work is most people would get their statement, they would pay their balance, and then they would move on through the next month of spending. The problem is just like that example James gave you, that customer was being scored using that snapshot model as if all his credit cards were maxed out, even though he always paid the revolving balance every single month. So that's one of the consumers that's going to be helped dramatically. One of the other ones we talked about that's going to be dramatically improved in score based on this trended credit data is the customer who is not an aggressive user of revolving credit, somebody who uses alternative credit to qualify. Those models now being able to report that information to the bureaus, that bureau information being fed into the system for underwriting purposes, not necessarily for credit score purposes. You may have somebody who has no score, or somebody who has a 630 or 640 score because they don't have a ton of debt, or at least not recent debt. Maybe they had a few old derogatories, because that's usually what happens with, that's what the whole Financial Peace University was really all built for, right? The customer who got in over their head, got in trouble, and needed help getting dug out, because it teaches budget and discipline of spending, which is a good thing, right? Yet they get penalized in the traditional scoring model because they just don't have enough positive points to offset the negative points from the past. So those are the customers that are going to benefit from this. When it comes to what you do on a daily basis and how you communicate with the audience, and how this could be leveraged from a business development perspective, is be the resource that's sharing this information with consumers that's helping them change and improve their lives. Beyond that, be the resource in the community, whether it is speaking at community groups and churches, whether it is educating the real estate community, or educating consumer groups in your area. There's a lot of different ways that you can leverage that by being the recognized credit expert in your market, by understanding the dynamic of how these things work, and then leveraging that to elevate your credibility with a potential audience of potential consumers. It's a great way to get yourself out there. Another great one is like, for example, lunch and learns at companies that have large groups of employers. There's another strategy where you can take this information and use it to help people by educating them on what applies as it goes through the underwriting process and how this is all going to work. And then hopefully that'll put you in front of some people who, when it is time for them to do something different with their loan or with buying a home, you become the expert they seek for support and service from. A great way of doing it. So, James, do you have a couple of these questions you'd like to knock out real quick?
I do, and in fact, what you were just saying dovetails perfectly with Janice's. I'm gonna go through them in order here. Janice's question about it's basically, do I have an opinion on whether or not a lender should open up the trended credit data and show it on the credit report to the consumer? And I think that what Eric was just speaking of, I think showing that to, taking that extra 5 minutes to show that to your consumer and explain to them what it is and why it's there, I think is absolutely a wonderful thing. I think it's going to separate you from those that don't understand it and are just kind of glossing over it and hiding from it. So yeah, my opinion would be that showing them that part of the report and explaining to them that, hey, this is something new. This is a way that your credit and the way you manage your finances is being used to evaluate you for the purchase of this home and perhaps in the future for other things as well. So you want to know that to manage this properly. I think that's a a very upstanding thing to do. Obviously, my caveat and Eric's caveat would always be make sure and talk to your branch manager, make sure that they're okay with you doing that, and that you're not doing anything that would potentially get you in trouble for giving out information or anything like that. But I think in general, as long as you're giving correct and unbiased information to the consumer that pertains to your industry, I think that that's a wonderful thing to do. Next one, Diana, HELOCs. And this is one of those, Diane, where you're right. That is the only situation I can maybe even think of where the good financial management strategies are actually running counter-indicative to trended credit data. So what Diane's question is basically, there's a HELOC that's a 2.5%, much lower than the primary mortgage. Now, congratulations to Diane, because she's going to have her primary mortgage paid off here in 4 months. But for people that did that and they still have 20 years left on theirs, and so if they're paying extra, they want to pay it to their primary mortgage that's sitting at 4.5% as opposed to the HELOC that's sitting at 2.5%. So I totally understand that, and yeah, there could be some issue there. But again, we talked about it's not an automatic decline, and if they go in and explain, well, here, this is how I'm managing my finances, I can't imagine that the final underwriting decision will be negatively impacted because they're making good financial choices by paying the higher interest note as opposed to the 2.5% HELOC. Okay, so I mean, we have sometimes, even though it doesn't always work out perfectly, sometimes we do have to count on that. There are going to be people out there with common sense that see, okay, yeah, that makes, that's the way that they should be doing it. And there's people sitting there going, no, we can't depend on common sense. But
and then of course common sense sometimes being uncommonly wrong because the common wisdom of the culture is a little misguided sometimes.
Very true.
Can also be an impact element. There's another good one in here that talks a little bit about how much will applying for new credit help.
It's not going to make any difference whatsoever. The application, the increase, none of that is changing as a result of trended data. So inquiries do still impact the score. There was a question about they're still going to get grouped. Yes, that the same way, if you've heard me talk about that before, for student loan, auto, and mortgage, any increase within 30 days, plus if they continue to apply within 15 days of the expiration of that 30-day window, all of those are still going to only count as one for credit scoring purposes, but that's only for credit scoring. That has nothing to do with trended data. Now, obviously, with that said, one of the slides earlier was talking about getting people involved that maybe aren't currently involved in the credit system, the unbanked, the unscored, kind of the people that maybe deliberately or maybe without even knowing it are following the Dave Ramsey principles and just don't even have hardly any credit. Opening some new credit and applying and getting some history is going to maybe allow them to, whereas you had to have a whole year to have a credit score, to even generate a credit score in some instances, there's going to be some instances where if they have that non-traditional credit and they open up some other information to generate some trended data, that they're going to be able to get exposed to the market maybe a little bit earlier than before if they can show their financial worthiness that way. So the actual inquiries aren't going to be impacting it, but the fact that they applied and got accepted and started using that card, that could actually help them quicker now than once trended data is in full effect than it did in the past. Okay.
Well, the other thing that was, and I'm struggling to find the slide at the moment in the background here, but one of the things that I also mentioned is, guys, as we cross the bridge into the launch of 10.0 here, one of the things you're going to see is not all of your credit reports that you look at are going to include trended credit data. Whether it's being applied to the underwriting system or not will depend on a little bit what type of loan you're actually doing, but you're going to start seeing this stuff on your credit reports pretty much every time you pull them, and pretty much all the major providers. I've talked with the guys at Avantis, I've talked to the guys at a couple of different credit service providers, but there's a number of different companies that are just wholesale. Everybody on the system is going to be getting this data because it's just to be consistent with Fannie doing it. to onesie twosie which report pulls trended data versus which one doesn't. All of them are going to include the trended data. So even if it's not being applied to the underwriting process, it's going to be there. James, there's one other question that popped in here that I wanted you to kind of address as well, which is, the whole impact of, I know you work with a lot of other industries beyond the mortgage industry. Are you actually seeing FICO score models out there that are actually using trended credit data as part of their scoring algorithm now?
Not yet. Not yet. Right now, trended credit data is only coming into play. Now, there are some non-Fair Isaac, non-Vantage scores that are trying to kind of get ahead of the curve that have started to incorporate some of this, but they're local, they're regional. They're, I don't know if everybody knows this or not, but the credit reporting agencies are different than the bureaus. The bureaus are those third-party companies that resell, like CoreLogic is a bureau, Experian is a CRA, a credit reporting agency. Some bureaus have developed their own scores that are trying to integrate some, but obviously that's not FICO, that's not Vantage, that's not even Beacon or Empiric or Plus Score. None of the big boys have incorporated it yet. Now again, because it is so predictive, and this is just one man's opinion here, but well, it's not just one. There's others besides me, but I feel very, very confident in saying sooner rather than later, this data is going to go into scores across the board. It's too predictive and shows too much, it's too much of an indication of their financial literacy and responsibility for it not to get included. I don't see another way for it to happen. So,
yeah, I mean, you just think about the billions of dollars that had to be invested in building the infrastructure to be able to not only track or obtain this data over a 30-month history on a consumer, but to also be able to, because I mean, this is a layer of reporting that the entities, the creditors, are having to provide that they've never had to provide before, right?
And that's right. And they've got this from the CFPB too. So I mean, the CFPB oversaw the entire study, and this is really, I mean, and they had just taken over the governance of the credit reporting agencies in October of 2012. That coincided with TransUnion.
Much of this research study, yeah.
Yeah. I mean, absolutely. I mean, Equifax had just acquired CFC, which was covering like 9 states, including all of Texas. I mean, about a third of the country. Equifax acquired that and became just as big as Experian, essentially. And TransUnion got acquired by private equity and started doing this. And right at the time, the CFP. So this is kind of, I mean, behind the scenes, this is kind of CFPB's baby as well. And so, I mean,
yeah,
definitely. So.
Well, and just the volume of information. I mean, you think about just the daily balance activity on even one credit card. How many thousands of bits of information is that going to be across the data? I want to do one quick thing here, guys. There are several more questions I want to try and get to, and James, I don't know what your time frames are today. I don't know if maybe you'd be able to stay over a little bit past the hour. Those of you, we are getting close to the top of the hour, so there's one thing I just wanted to let you guys know about. If you want more detailed information,
I'm good till 12:15 today. So.
Okay, perfect.
Sorry, I'm sorry to interrupt. Yeah.
That's all right, no problem. Guys, one last thing I wanted to introduce you guys to. James is going to be available to answer a lot of additional questions for you in a couple of different ways. As I mentioned before, James and I had a couple of years ago put together a 5-part webinar education, or what we call a web shop series that was called Becoming a Credit Educator, How to Win the Game of Credit Scoring. And we went really deep into a lot of the case-by-case information studies and how to understand a lot of the other variables, because a lot of the, trending credit data will change how revolving accounts are going to be evaluated. But a lot of the other stuff that goes into the scoring algorithms really isn't changing. So we're going to have available to you again, we are going to be relaunching that series with the Becoming a Credit Educator web shop. It will be done live again because of all the changes that are coming into play with this. So we are going to be relaunching that series again. It'll be a 5-hour to 90-minute, 60 to 90-minute sessions that are going to be available. You can generate, if you go to the website, maximumcoach.com/credit, You can sign up to participate in that. It's regularly $4.97, but James has been gracious enough to offer it at a little bit of a discount. As we're going back through the re-recording process here, you'll be able to get access to it for $2.97 if you use the promo code CREMAX. Again, you can go to that website, www.maximumcoach.com/credit. Type in the promo code and apply the CREMAX discount code, and that'll knock it down to $2.97 for you. Part of the reason we're doing this is because we want you to understand the foundation and the fundamentals of what scoring models are based on, the nuances of the inaccuracies of the reporting, like we were talking about before, the installment count that gets reported as a revolving. Well, that could be affecting their ability to qualify, and they may not even realize it. Why is it that you pay a collection which you think should be a responsible credit activity, and yet the score goes down? Well, most likely it's because that way that payment was reported to the Bureau or to the credit reporting agency was miscoded. It was classified similar to as if it was a brand new credit, derogatory, as opposed to something that's being done responsibly by paying off that collection. And usually those nuances and adjustments, and I want you to be very clear on something here, guys. We're not talking about how to manipulate or misrepresent credit information, but we are talking about you knowing how to investigate and resolve legitimate inaccuracies in the Bureau that are severely negatively impacting that borrower's score and significantly increasing their cost of lending, their cost of buying insurance, their cost of everything else. And then, of course, the fifth session in that program, we focus on a little bit, once you have the knowledge, how to spread the information and be a valuable resource to your community that's going to help you grow. So if you just go to MaximumCoach.com/credit, apply the discount code credit or CREMAX, that'll knock the $200 off the program, and that will get you in for $297. Again, it is a 5-part series that's going to run starting Monday, October, I can't remember the exact date.
Hold on, hey Eric.
Yeah, go ahead.
I know we had the CRE short for credit, but it looks like we have CREMAX on the other one and credit as the promo code here.
Either one should work. The one that I believe the one that's most accurate is this one right here, this credit, as the discount code, and we'll be getting information. If you guys have any problems with registering, if you're hopping on the website right now, hopefully, and taking advantage of that. By the way, they also do with James's new company, NewScore, and Charlet Credit Consulting and Education Services. They are available for individual consultations and educational workshops if you'd like to bring James and his team in to educate your loan officers. If you're a manager or owner, they do that as well. Or if you'd just like to talk about more information about getting some back-end support from their credit analysts and credit advisors that follow a very morally responsible and ethically high standard of really looking at the borrower's credit information, investigating the inaccuracies, and helping that customer through the dispute process to get those inaccuracies corrected so that their score is doing what it's intended to do, which is to be an accurate reflection of their overall credit risk, not a misrepresentation that is unfairly punishing a customer who is just fighting through the battle of having the inaccuracies in that bureau.
Essentially, what I would say is that if somebody is not the risk they're being represented, I don't want you to lose that customer, and I don't want them to lose the house. But if somebody really is that risk and they really are that risky, then they deserve the score they have, and I don't want you to risk your money lending it to them. That's just unfortunately because of the persistence in errors within the system, particularly in third-party collections. But it's not just them; they happen to be very, very rampant in third-party collections. But because of the errors in reporting, where they take a collection that's 6 years old and make it look like it is a credit card that went 6 months delinquent last month, as you can imagine, those have a very disparate impact on the credit score, and it's just we see it with such frequency that there's a good chance, particularly if somebody has the money set aside and the job and the assets and seems to be responsible, but the score just doesn't match up, that there's something amiss, that there's something being misrepresented, that if we just correct those dates, those balances, those misreported data, so that it's not removing data. They owe that money, and it's within the statute. It should be there. But making sure that's reported accurately, you would still be able to lend to that person because it's just that their risk is being misrepresented by the inaccurate or incomplete data. And so that's what we focus on. And as Eric mentioned, I separated and started these companies here not long ago, and particularly Charlet Credit Consulting about a year and a half ago. I started separate from the credit services because my real passion is for consumer advocacy and for education, as you might be able to tell from how quickly I talk on here. For that, we train real estate agents. Eric and I end up together a lot of the times all over the country from coast to coast, speaking and teaching on this and a myriad of other subjects. So that's really my passion. So I separated that out from the credit services. NewScore is the credit service company that it's separate, and it's there to help those clients. But aside from that, as Eric indicated, we love to just go out and teach. And teach to a group of mortgage loan officers, have the interaction kind of like we're having here with question and answer. And if you think that I know what I'm talking about and I can maybe help with some clients, we'd sure love to have them. Otherwise, I always say I didn't leave Experian. At the time they were part of GUS PLLC International, 650,000 global employees. I represented them on the stand in federal court and with the FTC and attorney generals. I think you can probably imagine they compensated me fairly. I didn't leave because of the money. I left because I felt that consumers weren't being properly educated or represented, and that's what my passion is and what I want to do. So without further ado on that, we'll get these other questions. There's a couple real quick here I just want to knock out because they're kind of housekeeping stuff. Slides be available for download later? Absolutely.
Yes.
There's one renters monthly rent payment. Oh, go ahead.
Yeah, just so everybody knows, within 48 hours or less, we'll be getting a follow-up email out to everybody who registered for today's program with a link to the recording, download of the PowerPoint. We're going to go in and there's a couple of quick editing things I noticed as we were going through today that I need to clean up as well on the back end, but we will definitely make sure that you guys have access to this resource after today's event. In addition, the credit education, becoming a credit educator program, there was a quick question in here about if you've been through the program before, are you going to be able to get access to new information? And, I'm pretty sure, James, you're okay with that. I mean, we always did this we intended this program as a little bit more of a membership and education program. We can't really call it certification, but we had always intended it to be more of a community process, and so you're more than welcome to participate this time around again. Those of you who'd like to participate and want some additional information, by the way, feel free to post in the Q&A and chat here now if you would like somebody with James's team to follow up with you about a potential event or about getting connected with them and allowing NewScore and their credit investigators, their credit correction and educator team to work with your customers on your behalf. Again, the customers that need a lot of work, the customers that need a lot of hand-holding and coaching and counseling on how to get their budget back on track and how to more responsibly manage credit. It may be better off for you to refer that to James and his team of analysts as opposed to trying to do it yourself, where you can focus on going out and getting more loans. But that can also be an incubator for you. That can, help you when those clients do get ready 6, 12, 18, 24 months down the road. James and his team will help you get them back to the agents who introduced you to them to begin with. But anyway, yeah, James, go ahead if you want to go ahead and hit some of the other questions here.
Yeah, sure.
Go for it.
Let's see. There was one that renters, monthly rent payments. It's going to depend on whether or not that they're reporting. There are some organizations where they pull together a whole lot of apartment complexes, like Lincoln Properties has done that, but typically rent data is reported to a different type of reporting agencies. There's consumer credit reporting agencies that are Experian, Equifax, TransUnion, and I know this. If you ever hear them talk about the fourth, that's what they're talking about is I know this. But then there's also Rent Debt and Tenant Tracker. They store information particularly for leasers and renters. Okay, so sometimes they'll incorporate the information from the consumer credit report, but it's a separate reporting system. So typically, that's where that data is, and no, in that instance, it would not be included in the trended data calculation.
Right. Now, specific to that question, James, one of the things I had come across recently, and I'm not sure if you're aware of it or not, I would think you would be, but someone had recently introduced me to, there are a couple of public websites where you can essentially voluntarily, if you can get like a rent essentially what we would call a VOR from your landlord. You can submit it through, and it is a paid service because the credit reporting agencies do charge for vendors to be able to report data, but you can actually, I think it's through like RentTrack was one of them, right, where a consumer can get their verification of rent. They can then pay RentTrack to take that information, and then RentTrack will verify it and report it to the three primary agencies, as I understand it, which I thought was a really cool system for doing it. Again, it's a little expensive for the consumer, and it is a little time-consuming to go through that process because you've got to go through those multiple steps. But it is a way to get legitimate rental data published on or figured into the actual scoring models as well, because any information within the bureau will be picked up in the score, right?
Yeah, and absolutely those exist. Experian really resisted for years against that. They didn't think that it was necessarily, well, I think essentially they didn't think they made enough money off it. Is the truth of the matter, but because there were a lot of times where it would be Equifax and TransUnion only. But recently here, Experian has been accepting that data as well. I will tell you before you do it, just depending on what state you're in, the only one I can say emphatically I know exists is California. But I would be surprised if some other places like Minnesota, Connecticut, Massachusetts, some of the more kind of left-leaning states, Washington, don't have a similar program as well. Essentially, same exact thing Eric's talking about, but it's a non-profit group that they pay the fees to the credit reporting agencies through fundraisers and donations, and they help the indigent or those that can't necessarily afford that. But from what I've seen thus far, that is a state-specific. So if you're in Alabama and you want to do it, you can't do it through the California agency. But those nonprofits that do that, they report to all three. So just if you have a consumer in that situation, maybe double checking your state, see if there is some before we send them to the paid ones. Some of them are not for profit. Otherwise, if they've got some money and they can do that, and they just have never really, maybe they're doing the financial piece or something like that. That is absolutely a fantastic way for them to start to build and, kind of get some backdating to their credit history. So.
Yeah, definitely. All right, so there was another question in here, and it kind of went back to the whole revolving credit. Now, this, I guess, and permit me to play dumb a little bit here, James, but if trending credit data is still, primarily looking at balance to limit ratios, does the same rule still apply that higher limits are better for score overall? i.e., if I have 20,000 in limit and only 10,000 in balance, my score is going to be better, even if I carry that $10,000 balance or I roll it over month.
Yeah, that's going to be better for it. I will say that I wouldn't necessarily put it to say that it's primarily looking at balance limit ratio. I think, and this isn't exact, but I think this is a better way of thinking of it. It's primarily looking at what your minimum payment was and what multiple of that you were able to pay. I think that part is more important to trended data. So you had to pay $25, but you paid $100. That 4 times factor, that you were able to pay more than what was due and lower that outstanding balance, that's more important than the balance limit ratio. Not that the balance limit ratio is not there, but paying more than what you had to towards that outstanding balance is going to be the most important factor there.
Right. Well, and I think the important element of that is remember that this was all done by math, right? These are all done by mathematical. That's what algorithms are. Algorithms are mathematical equations that are preset to look at specific data and do a calculation so that multiples of minimum payment element, if you're 10x or 20x minimum payment, you're probably going to factor better in the trended credit data scoring model through the automated. And again, remember, trended data is only about underwriting through Fannie Mae right now. Everything else is going to be more or less the same old story. So still, balance to limit ratios, if you have a 20% balance to limit ratio and all your revolving is paid as agreed, you're probably going to have a significantly higher score than if you have an 80% balance to limit ratio and your payments are all on time. And
hey, Eric, you want to see everybody hang up all at once?
Sure.
Predictive economic quadratics.
Okay, I think I might be able to follow that word through with about 20 minutes of thinking about it. But what does that really mean?
It just means that they are using the same kind of principles that Dan O'Reilly, who did Predictably Irrational and Why We Lie. They're taking those predictive economic principles and applying them to algebra and calculus like quadratic equations. So they're doing predictive economic quadratics in order to get to where they want to be with the predictive indicators within these algorithms. So it's
Right.
complicated, but at the same time, it makes sense. The same kind of thing that that O'Reilly talks about. Why is free so important? Why will somebody take a 5-cent Hershey's Kiss for free instead of a $1 Lindt chocolate for a dime when they're only saving 5 cents instead of 90 cents? And it's the power of free. Free makes they'll give up that other 85 cents because it's free, and they take those same kind of predictably irrational principles and apply them to the math here.
That's an interesting story or analogy. I've not heard that one yet. No, guys, but that's like I said, the more you know about the math that's behind the scenes, the more you know about the amount of data and the type of data that's being reported, and the more you understand how that factors into the overall scoring algorithms and modeling that's being done. And keep in mind, all that data comes from history. It's no different than why does a single 18-year-old male pay more for car insurance than a 35-year-old married female? Well, because statistically the 18-year-old is gonna have a wreck X percentage of the time. There's like less than 0.002% chance of that 18-year-old not having some sort of car crash in his first 24 months of driving.
And there's so much more likely.
Predictive.
That's right.
Right.
And they look at all of these and factor in. Well, and there's a 3 to 1% chance they're going to drive while intoxicated, and a 10 to 1 chance that they're going to be speeding at some point during that time and get a ticket. And also make there's all that.
Trust me, I have a 15-year-old who's just started to drive now. Yeah, and my oldest boy is driving for years and years. But yeah, guys, it's based on millions of users and studying the data patterns and studying what has happened over millions of consumers over the years, and that's where these numbers have become so accurate and so predictive of whether they are or are not. The key to that, though, is when you have information that is inaccurately reported into the system, garbage in, garbage out. If inaccuracies are in there, if there are, if the information is 99.9% accurate, but the 0.1% of the inaccuracy happens to put the wrong number in the wrong part of the formula, and it moves the date of that account from 24 months ago to 2 months ago, well, it's going to negatively impact the score way more egregiously than it should. And that's where understanding and knowing what these scoring models are, going deep into what is going to be factored into that borrower's consumer score, which is what's going to be determining whether or not they get a loan or at what rate they get a loan. You need to know that as a mortgage professional, because your consumers are going to be depending on you to guide them to how to eliminate those issues or barriers. And that's the whole reason we built this Becoming a Credit Educator program, is we wanted to empower originators to make a real difference at the consumer level of getting consumers the information that those consumers desperately need to be able to correct those inaccuracies, and again, legitimately, accurately, and verifiably investigate, identify, and then correct the inaccuracies in their bureau so that their score becomes an accurate reflection of their credit risk, their lending risk. This is what the whole system was designed to begin with. So again, one last time, I just wanted to invite you guys to join us for that program. Like I said, we're going to be running basically Mondays from 3:30 to 5 Central Time, starting I think the second Monday of October through the first Monday of November. I don't have the dates right in front of me at the exact moment, but you can check out our website. And by the way, those are going to be recorded and put on video for you, as well as a whole library of resources that are available. Again, today's program is going to be available for you on follow-up. We'll be getting that out to everybody who is registered for the program. Within the next 48 hours or so, you'll be getting an email if you're registered for today's program. If you'd like more information or would like James and his team to contact you about some of the other services they provide, as far as the educational services from James directly with the Charlet Credit Education organization, as well as from NewScore, his credit analysis and credit education and correction company, feel free to just go ahead and post that in the Q&A right now. Otherwise, we'll be signing off as we always do with this program, which is, okay, you've invested, an hour and 15 minutes of your time learning. Now do something with it. Knowledge is only useful and valuable when it's applied. So use these 4 quick questions before you answer that next phone call, before you return that next email. Take 30 seconds and put an action plan in place. Because if you follow this 4-step plan, you have a 95% chance of actually following through on doing something with this valuable information. Of course, if there's anything myself or the rest of the team here at Maximum Acceleration can do to help or support you in that, please don't hesitate to reach out and ask. One of the things we've always said over the years is, the easiest way to find out about the value of coaching is to experience it. So you're welcome to participate. We offer what we call a no-cost, no-obligation strategy session. If you guys would like to take advantage of that strategy session, feel free to just post the best phone number and email address here in the Q&A platform of the webinar, or you can go to MXLCoach or MaximumCoach.com/strategy and post that request for a strategy session right on the website as well. I'm going to go ahead and sign off, and James, I know you got to run to your
I got to go there. Thank you, everybody.
I'm going to leave the webinar platform. Yeah, definitely. James, any final thoughts you'd like to share with the group before you take off?
No, not anything in particular. I mean, obviously, this is still a fluid situation. If things change, I'll do my best to communicate to people what it is. If you're on that, obviously we give the most up-to-date information when we do those classes. So if you're in the class and anything changes with this, you'll get that update as well. Things, like we said, it was supposed to start in June and it's not rolled out yet. Things change all the time. So
yeah.
All right.
Yeah, definitely.
Thanks, everybody.
Thanks again, James.
Take care, bud.